Welcome to another edition of Inside Rosenberg and Estes. I'm Dave Lorenzo, and today we're talking about leases. When you think about a lease, you probably think about paying rent. You probably think about how much the value of your space is, whether it's an apartment, a condo, a co-op, or the entire building. Well, our guest today is Bill Byers, and he has a different take on how we should view a lease. So join me in welcoming Bill Byers to the show. Hey, Bill, how you doing today?
Hey, Dave. Good. How are you?
I'm doing great. So when we think about a lease, Bill, what should we be thinking about? Instead of thinking about it just as a bunch of terms on a sheet of paper, what's your take on how we should view a lease?
You should really view a lease as the agreement that governs the relationship between the landlord, the tenant, and the building, kind of an operating agreement of how it all works.
Okay. Well, when most people think about a commercial lease, they think about rent and terms and signatures. You know, you've said that the lease is something that's so much bigger than that. So help our audience understand why the lease should be viewed as a strategic tool or an asset in the building.
Okay, well, the lease is there to, allocate risk among the landlord and tenant. It tells the landlord how the income's going to grow. It tells the landlord and tenant what happens if there's a problem, what happens if there's a default under the lease, how does it get resolved.
So the lease is not just documenting the relationship, it also shapes the economics of the building.
Yes, when you go to buy a building or you invest in a building, you're not investing in concrete and steel, right? You're investing in future cash flows. So in that regard, you have to protect the income. You have to look at the durability of the income, how long the income is going to be coming in for, the predictability, how much of the operating expenses are you going to be able to have to get reimbursed for when the rental increases. And you're also looking at the quality of the tenant, the quality of the income, really. But you look at the tenant for that. Who's paying, how good of credit do they have, and so on.
So you're a lawyer. When
Right.
you sit down with a developer, with a landlord, with the owner of a property, what are some of the things that you're initially looking at in the structure of the lease to make sure that that developer or that landlord is going to be able to get the value from it?
Well, we look at all the different economics and how it factors in. We look at what concessions have been given. We're looking at for termination rights. We're looking at assignment rights, how broad they might be. We're looking to make sure the developer or landlord can get reimbursed for operating expenses and what the income stream is.
So in there, you mentioned a whole bunch of rights, but one of them was assignment rights. So that pertains to the sale of the building, right? So if I'm going to buy a building, I want to make sure that when I buy it, they can basically assign me the rights that the previous developer had. Do those automatically transfer, or it has to be written into the lease that says, hey, when somebody new buys the building, we're automatically going to transfer the rights to you?
Well, when the leases typically have language that say that, the current landlord can sell the building and the lease will apply to the subsequent landlord.
Mhm.
When I was talking about assignment rights before, I'm talking about a tenant assigning their space.
So
right?
like subleasing.
Right, subleasing or assigning it to a whole new entity, and
Okay.
trying to walk that. In that case, the tenant's hoping to walk away, but they really don't.
What is the kind of, garden variety assignment provision look like? I mean, are building owners or landlords of commercial properties, are they open to allowing assignment provisions in their lease? I would think if you're leasing space to me, you're leasing it based on my credit and my ability to pay you back.
Correct.
You really don't want somebody else coming in, right?
Right. I mean, exactly. You make a deal with a certain tenant, but
Mhm.
it's also market, and it's also important for a tenant to have kind of what I would call an escape hatch, right? If the
Mm.
tenant is having trouble and they need to, it could be they're having trouble, then they need to get somebody in there to fill a space so they can pay the rent. Maybe they don't need as much space anymore. Those provisions are common, but you want to have controlled assignment rights. You want the tenant not to be able to freely assign it or freely sublet it, because once the new party comes in, the new tenant comes in or subtenant comes in, you have a different credit risk, right? Especially in an assignment case where you have a new tenant coming in altogether.
So let's flip that on its head, right?
Right.
So now I'm the tenant, and the lease also protects me from having somebody new come in and just boot me out and say, listen, I bought this building and I bought it based on what the rent roll was. And the rent roll is what everybody who is in the building is paying, right?
Right.
And then I say, well, some of these rents are below market. Can I just throw people out? No, the lease protects the
Right.
tenants from that too, right?
Right. The lease is binding on the incoming landlord as well.
So what is this? We were talking about, and I heard you mention a harmless provision. What is a harmless provision?
I think what you're referring to is when something looks harmless on the day you sign the lease and might not be so harmless down the road. A
Oh,
good example of that would be a termination right. A tenant might come to you and say, "Hey, we really want this space. We want it for 10 years, but the way we operate, we need to have flexibility. We need to have the right to terminate halfway through the lease." And everything else might be great, and all the other economics might be great, so the landlord might agree to it. And then what happens is when you really look at it, instead of having 10 years of predictable income, you really only have 5 years of predictable income if the termination right's at 5 years. And after that, you don't know what you're getting. So that affects the buyer of the building. That affects lenders. They're cutting off that income stream after 5 years. It's predictable to that point. After that, it's not so predictable.
oh, that's really interesting. That reminds me of like contracts for sports players, like baseball players, where
Right.
it's a 5-year contract, but he can opt out after year 2.
Right.
So it's only a 5-year contract for one side because they can opt out after the second year.
Yeah.
All right, so let's make this concrete. Suppose we have 2 buildings that are
Okay.
next to each other, right?
Right.
Same neighborhood, same size, similar tenants, similar base rents. On the surface, they look identical. But once we read the leases, we may discover that they're different. So if 2 identical buildings are sitting next to each other with similar tenants and similar rents, how can you, as the transactional lawyer, the real estate law expert, really make one building more valuable because of the way you structure the leases?
Well, it's similar to what I just said about termination rights. You have to two buildings, same rent, could be completely different because there might be no termination rights in building A. Let's say there are tight or strong economic recoveries for operating expenses. There are controlled assignment provisions. Building B might have a termination right, which cuts off the term, as we just discussed. They might have broad assignment rights and sublet rights, so your tenant could change much more easily, and it might have weak recovery provisions for operating expenses. So you may not get back everything you're supposed to get back as far as running the building on a day-to-day basis.
Interesting. So when you represent buyers who are buying buildings, right?
Right.
When buyers represents buyers who are buying buildings, what is the due diligence process that you walk these folks through? Do you have like a checklist where you sit down with them and you go, okay, here are the first 5 things we got to look at? Is that something that you do?
Absolutely. And we typically will be asked to put together an abstract of all the material terms of the agreement. And that will be, what the rent is, when does the rent bump up, how long is the term, are there renewal options, is there free rent that's still owed, is there still tenant improvements allowances or landlord's work that is still owed under the lease? What do the operating expenses look like? What's the base year?
It's interesting that you say that, Bill, because that raises another issue in my mind, and that is bankruptcy on both sides, right? What happens if the building owner goes bankrupt? What do the leaseholders have rights if that building is then assigned to a bank? Like if maybe they don't pay their mortgage and the building is assigned to the bank, do they still have the same rights in the lease, the people who are leasing from the landlord?
Well, the lease will spell out what happens in the case of a lender coming in and taking over.
Okay.
Major tenants will get subordination agreements, and they'll get some comfort from that the lender won't terminate their lease and that they'll be able to continue on without being disturbed. From the tenant side, if a tenant goes into bankruptcy, the landlord is, going to be subject to the bankruptcy court. And, it's a different playing field. The remedies will change. The remedies will be limited. The claims that they can make will be capped, and they'll be subject to automatic stay. So if there's a default, they might have to go to the court to get permission to send a default notice. The tenant will have to either assume the lease or reject the lease. If they assume it, they're going to have to, they'll have to continue to pay occupancies while they're in there. If they reject it, well, then you're lining up just like any other creditor in the bankruptcy.
Interesting. And I would imagine that this is something that you want to negotiate on your way in rather than wait for something to happen, right? I'm sure this is something that you flag with your clients and you say, okay, we need to put if you're leasing space, we need to put a provision in there, or we need to examine the bankruptcy
Right.
provision to make sure that your interests are covered. Is there any industry in particular that where you would say to as a landlord, where you would say to the landlord, look, I know these people are willing to pay market rent or above market rent, but you got to be really careful because this is a volatile industry where we got to be like, you put a special provision in there.
We always take a look at each tenant and, in particular, and we look at what their business is and how much of a risk they are. And we have bankruptcy counsel here, and we'll model the provisions after, depending on the situation. We also try to build a very strong bankruptcy provision into the lease. But bankruptcy is a different court, and they're a court of equity, and they may not appreciate everything that we put in there, but we try to build it as strong as we can.
Let's talk about any kind of surprise lease provisions that may trip people up on the landlord side. Is there anything that you've seen that should be where you should pay careful attention as a building owner?
Yes, I think that you need to look for termination rights, as we discussed. You want to look for contraction rights, where they might be able to shed some of their space and thereby shed some of the rent. You want to look to make sure that your tenant that you signed up with or that you're taking on when you buy a new building is going to be your tenant in the future. So you want to have controlled assignment rights. And you want to make sure that the rent is growing like it should be, and you want to make sure that you're recovering the operating expenses that you should be.
So if you're a tenant, then which lease provisions are you going to be particularly concerned about, or which lease provisions are particularly frequently negotiated?
Frequently negotiated, I
Yeah.
would say, we're looking at the assignment provisions, pretty heavily negotiated. Typically, default provisions, they try to negotiate pretty heavily and make sure they have proper notice of something happening. They also look at they always look at the use, right? They look at the free rent provision. When you give them free rent, they look at alterations to make sure they can alter the space the way they want to.
Yeah.
They're looking really for, they want to make sure their rent's right. They want to make sure they can get out if they're having trouble, which is your assignment and sublet provision. They want to make sure they don't trip up over default. But those are the big things.
Is there ever any like dispute or negotiation over like courts of jurisdiction and arbitration versus like, being able to go to court? What do you see in there?
It depends on the players in
Mhm.
each case, right? You have tenants that have a lot of firepower behind them, and they're more than willing to go to the courts. And there's situations where the landlords are the ones with all the firepower, and they're happy to go to the court too. But it really depends on the two together.
I wanna just touch on subleasing really
Okay.
quick because this is an area of particular interest, and I am under the impression that subleasing because you address assignment in a lease, subleasing is something that happens probably more often than the average person knows, right? Does it happen frequently?
Yeah, subleasing happens frequently, probably more frequently than assignments of a tenant assigning its lease.
Okay.
Tenants might have changing business environments. They may not have as many space needs. They may be looking to get out of the building,
Mhm.
or they may be financially struggling.
Yeah.
And honestly, when we get a request for for a sublease consent, I think one of the first things that should be going through people's head is not so much who the subtenant is, but why are they leaving? And are they in trouble? And did we think we were getting a renewal out of them, and suddenly we're not going to get a renewal out of them?
Yeah.
You know,
So I actually faced this. I ran a business here in Manhattan, and I faced it for positive reasons. We grew, and we needed more space, and we were kind of landlocked in the building we were.
right,
So I went to the landlord and I said, "Hey, would you mind if we subleased our space because we need bigger? So I got to move somewhere else. I'll keep paying you the rent. We're with the guarantee, everything. We're still
right,
on the hook,
right,
so you don't need to worry." And what ended up happening in that case is the landlord was like, told us that they had another tenant that was moving out, and they said, "Well, we just won't renew those people, and you could take that floor, so you can stay in the building," which worked out great for
right,
us. So I want to clarify, you do need to you do need to connect with the landlord and I guess get permission, right, from the
right,
landlord to
right.
do that. And then you're still on the hook for the rent. So somebody else is
Correct.
paying you the rent and you're still on the hook.
Right. The proper way to do it is always make sure that landlord has consent over any type of assignment and sublet. And if there's if it's a related party, you might have a slightly different situation. And, and if there's some type of privacy concern, you might get notice afterwards. But other than a related party, like an affiliate or a parent entity, landlord would have consent. And yes, the tenant that you made the deal with should always remain on the hook.
Yeah. Okay. So if a landlord is listening to this and he or she wants to use leases as a way to increase the value of the building, what's your guidance? What should they do?
The most important thing to be looking at is the predictability of the future income. You want to protect your income, meaning you want to protect the rent coming in. You want to protect the net operating income, which is your profit, essentially, right? So you want to make sure that you've got strong recoveries for operating expenses, and they don't have termination rights, and you just want to protect that margin, essentially. And you also want to, make sure that you have flexibility going forward.
I think this is a great place for us to pause the conversation, and we can pick it up on the economics of the lease in our next discussion. Bill, if people have listened to the show and they want to get a hold of you, what's the best way for them to reach out to you?
They can call me anytime at 212-551-8456.
212-551-8456, or they can email you, and we're going to put the email on the screen right now. It'll be also down below in the show notes. Bill, it's been an absolute pleasure having you here on Inside R&E today. My name is Dave Lorenzo. Please be sure and join us. Follow us wherever you get your podcasts and on YouTube. We'll see you next time for the economic value of our leases.